This video is sponsored by Caleb and Brown. They help their clients buy, sell, and swap cryptocurrencies with a 24/7 personal broker service. Sign up today.
And yeah, let's learn about crypto taxes and just the comparison between the Japan and the United States. So here we go. First one's coming from Coin Edition. And taxes, big hand up there. But Japan taxes cryptocurrency as income with rates up to 55%, including inhabitant tax, and the US taxes crypto as property, applying capital gains rates based on holding period. So there's already a difference there. And both countries tax crypto transactions, but exempt certain activities like holding and gifting. So let's learn a little bit more about these differences. Japan and the United States have a very different way of taxing cryptocurrency. This article breaks down those differences, comparing tax rates, taxable events, and how each country classifies cryptocurrencies. Japan's National Tax Authority classifies cryptocurrencies as a miscellaneous income, while the United States Internal Revenue Service treats them as property. This fundamental difference leads to variations in how crypto-related activities are taxed. So first up, tax rates and taxable events, a closer look. Now let's take a closer look at how these classifications translate into tax rates and taxable events in each country. Japan classifies cryptocurrencies as a miscellaneous income according to the National Tax Authority, and crypto earnings are subject to progressive income tax with rates ranging from 5 to 45%. In addition, 10% inhabitant tax applies, bringing the total tax rate between 15 and 55%. While the United States, on the other hand, treats cryptocurrency as a property for tax purposes. The Internal Revenue Service typically applies income tax and capital gains tax depending on the transaction and holding period. Now, in Japan, any crypto earnings over 200,000 is that yen, which is $1,600, must be reported to the tax authorities. This includes profits from trading, mining, staking, and airdrops. In the US, taxable events include selling or spending crypto. Tax rates vary depending on the holdings period and type of income. So that's another thing. So yeah, if you're in America, you're being taxed from trading, selling, and spending it. You're not taxed on buying and just holding within wallets or moving it between wallets. But that makes you think, like, what am I causing it? If you're trading on Coinbase, yeah, you are getting taxed up the wazoo for each trade you do on there. So why it's kind of a little better to, like, if you just purchase crypto there, move it to a non-custodial wallet. That way it's in a wallet that's okay for holding. That's not taxable. And then use sites like ChangeNow or SimpleSwap, which is an anonymous trading site. Just go, I want to trade Bitcoin for that coin. And you send it back to your non-custodial wallet. And then, yeah, so that was just wallets moving there. It's decentralized. Governments don't know what you're doing there at that point. So that's kind of ways to untrigger that event. But let's continue on with the article. Crypto tax rates, Japan versus the USA. Japan uses progressive tax rates for cryptocurrency income. The total effective tax rate can be as high as 55% for those with high incomes, and Japanese businesses face a 30% corporate tax on unrealized crypto gains. Although reforms may eliminate this in 2024 in the United States, the tax burden depends on the holding period. Short-term capital gains is less than a year and are taxed at federal income tax rates, which range from 10 to 37%. Long-term capital gains, more than 1 year if you're holding your crypto, have lower tax rates between 0 and 20%. Now, unlike Japan, the US does not currently tax unrealized crypto gains for businesses. I think that's what Harris wanted. But however, the Biden administration has suggested applying the wash sell rule to cryptocurrency, which would prevent taxpayers from claiming tax losses on crypto sales unless they sell the asset permanently. Now, taxable events in both countries. Japan taxes a wide range of crypto transactions, including trades between crypto and fiat currency, exchanging one cryptocurrency for another, and using crypto as payment. Gifting cryptocurrencies and receiving payments in Bitcoin or other digital currencies are also taxable, and the tax is calculated based on the fair market value of the crypto in Japanese yen at the time of the transaction, and income from mining and staking must also be reported. Now, in the United States, capital gains tax applies when selling, trading, or using crypto for goods or services. This tax is based on the increase in value since the purchase. Now, income from mining, staking, and airdrops is also considered ordinary income and must be reported on. However, gifting crypto in the US is not immediately taxable unless the value is more than the annual gift tax exemption. So what is that amount? Because yeah, if you're moving your crypto to a non-custodial wallet, you could just say you gifted it to somebody, and yeah, if you send it to a non-custodial wallet, how would the government know There's nothing linking you to that other wallet other than a seed phrase on the decentralized ledger. So that's kind of weird. But again, they do say there's a limit on there. Let's continue. Now, both Japan and the United States offer tax exemptions for certain cryptocurrency activities. Simply holding cryptocurrency or moving it between wallets is not a taxable event in either country. And additionally, buying cryptocurrency and donating it to recognized nonprofit organizations is tax-free in Japan. But in the US, buying and holding crypto is also not taxed, and transferring crypto between wallets and gifting and giving it as a gift below the tax exclusion limit are also non-tax. So again, as I say, and like there is a limit to what you can gift a person in crypto. What's that number? I don't know, and this article doesn't go over that. But what are the potential future changes with crypto taxation? Both countries continue to adjust their crypto tax laws. Japan has recently proposed eliminating taxes on unrealized crypto gains held by companies, and the US may introduce new regulations, such as the wash sell rule for crypto. Now, in 2025, regulatory authorities in both countries are exploring ways to update their tax systems to reflect the evolving nature of digital assets. So there you have it. So if you just didn't know about what crypto taxing is, definitely in the US, that's what a lot of people ask. It's just if you move crypto, like you move, sell, trade, or use it for services. That is it. And really, it is on if you're dealing with financial apps, exchanges, any centralized entity out there, they know what you're doing. But if you're playing on the DeFi side, that's up to you what you want to report onto the tax. But again, any tax questions you have should be asked to your actual tax person who does your taxes. Because again, I'm just a guy who reads the news and learns a little here and there and what you can and can't do, just to be aware of it. So that was our first article for you.